The ChatGPT moment for robotics is right around the corner. That's according to the CEO of NVIDIA, who recently said that he thinks the robotics industry could be the largest technology industry the world has ever seen. So when NVIDIA invests in a robotics company, what do you think happens? That's right, little Johnny. The fin twats catch wind of it and send the stonk to the moon. Today we're going to talk about a robotics technology company that NVIDIA holds shares in that's up 800% since last summer when the big news came out that NVIDIA was holding shares of this firm. Now, in order to determine which publicly traded stocks NVIDIA holds, you can go look at the 13F forms they filed with the SEC. The next one will be filed in February, so we're stuck with the latest one that was filed in November. And here we've simply looked at the difference between the most recent filing in November and the first filing in February. You can see that they added Applied Digital. We covered that recently. You can also see they removed Too Simple. That's because that firm moved to China and pivoted into something else. Bit of a drama around that. And they added Serve Robotics, which we're going to cover today. So the question I have here is, why does their investment in Serve Robotics only appear recently when they've actually been invested in the company for a while? Here you can see this article from 2022, which talks about how NVIDIA invested $10 million in Serve Robotics. What we can then do is start to extrapolate share price from that. So $10 million and 2.676 million shares, about $3.74 a share. Then they added 62,500 shares, largely irrelevant. And then most recently, NVIDIA added just over 1 million shares at $2.42. You can compare that to the price that people are paying today, $17 per share. And our math check shows that things roughly add up. What it comes down to is this. NVIDIA increased their Serve Robotics holding by 38% when a convertible note came due at a value of $2.5 million, roughly a rounding error for a company that size. Whoopee-doo. How many pundits out there took the time to examine the context here of NVIDIA investing in Serve Robotics? You see these articles, utter trash. Could Serve Robotics become the next NVIDIA from Motley Fool? They simply run that title with any company name. Then you have some quality commentary from Seeking Alpha, a dirt cheap AI stock with huge upside. What does that even mean? So let's start with that dirt cheap comment. When you have firms that aren't profitable, you can't use traditional price to earnings metrics. You need to use something else. Typically, firms will use price to sales. We use what's called a simple valuation ratio, which is market cap divided by annualized revenues. Now, annualizing revenues doesn't work so well when they're not consistent from quarter to quarter. Here, what we're going to do is just use last trailing 12 months. Now, the first thing I'll say is that we need to see at least $10 million in annual revenues from any company before we have any interest at all. That's to prove that they have some traction, and right around that time, maybe you'll start to get an idea of how profitable their business is based on cost of goods sold. Not operating profits, gross margin, which shows the potential profitability of a business. So to calculate the simple valuation ratio for Serve Robotics, we're going to use the last 4 quarters. As I said, that's about $1.68 million. We're going to take the $917 million market cap, divide that out. We get a simple valuation ratio of 546. I think that's even more expensive than quantum computing companies, which are at nosebleed levels. Now, our catalog average is 6. And our limit, where we consider things to be too rich, would be 3 times our catalog average, or 18. So Serve would need to have about $50 million in revenues to have an SVR of 18. So currently it's being pumped by a bunch of morons who don't consider any of this. But let's look at the viability of this investment thesis. So the big news, of course, is their relationship with Uber. That's because they were spun out from Uber in 2021 as an independent company. They plan to manufacture 2,000 of their robots this year for Uber Eats. That was a major expansion deal that they signed. They went public in a reverse merger, so we're never happy to see those because they skip the traditional IPO vetting process. They've announced a major partnership with Shake Shack, and, well, these partnership announcements and $5 might get you a hot dog at Shake Shack. They really mean nothing until this firm starts executing. So these counterparties that sign these deals, they have little to lose and all the leverage. And when we think about Uber, we recently did a piece on that firm looking at whether autonomy is a threat or an opportunity. Well, clearly, Uber wants to utilize the best autonomous technology out there to increase their margins because it's quite a low margin business. That's really a big component of the Uber bull thesis, is the emergence of autonomy. Whether or not Uber can capture that remains to be seen, but they have certainly signed up with quite a few vendors of autonomous technology. Some we've listed out here, and of course one of those is Serve. Progress so far. Serve had an average of 48 robots completing deliveries each day in the quarter that ended in the summer of last year per the company's earnings data. So we can start to learn something from that. These robots were active for about 8 hours per day. That's going to increase with their new flavor. I think they're on the 3rd generation. But one immediate problem that stands out is the fact that they're having a negative gross profit right now, and we're going to look at that in a bit, but these 3 revenue segments, software services, where they're licensing software to Magna, a large firm that also happens to be producing the robots, and also from delivery services, they're capturing, of course, revenues there. And then branding fees, potentially advertisement coming from the robot. So some back-of-the-napkin math. The Q3 2024 delivery services revenue divided by the number of hours gives us a value, $241. We can do the same thing then for the quarter previously. Again, $241. It's odd how these numbers match up. What that implies is that their current business model is to charge their client, of which the majority, vast majority of their revenues come from a single client. We'll assume it's Uber. They charge them not based on deliveries. Now, what they plan to do is increase robots by 33 times. So that would imply $3.7 million in delivery revenues per quarter, or about $15 million per annum. Well, when you look at what the company says, that when all 2,000 robots under their Uber Eats agreement are at full utilization, they expect to generate $60 to $80 million in run rate revenue annually. So 4 times the back of the napkin math we've done here. But the bigger question we might have is this: how profitable is this business? So it appears to be a fixed cost that's being paid by Uber, so roughly it's being subsidized. They're going to eventually need to move to a variable cost, and they said they can get that down to around $1 per delivery. When you look at these other segments, the software services component seems to be variable at best. Then you have branding. How much value is there really in branding? I guess we'll see. Uber's relying on autonomy to transform their profit profile. So how much of that loot are they going to be willing to share with Serve, especially when they have all the chips at the negotiation table? So this isn't very compelling, especially when you consider just how much dilution has been happening. So their recent quarter, they had this announcement about expanding into other geographical areas. They raised another $86 million, which they say extends their operational runway through the end of next year. Of course, at the cost of existing shareholders being diluted, this chart shows that their shares outstanding have roughly doubled in 8 months. That's not good. They also announced this agreement to acquire Vebu, which is a firm that had built this avocado processing robot called Avocado. And that's a bit of a red flag here. So the most recent news I can find is that this avocado machine has been debuted by Chipotle in a single store, and that the reason Serve Robotics acquired this Avocado robot is that so they can expand their operations beyond delivery and into back-of-house restaurant automation. Bad idea. Why don't you focus on expanding your delivery services, your core competency, what investors are paying you to do, instead of getting distracted and starting to pivot into other things? That's never a good sign based on what we've seen in the past. You do that later once you've reached economies of scale. Another interesting tidbit is that the founder and CEO of Vebu, this Buck Jordan fellow, is going to join Serve Robotics, and he was an early investor in Serve Robotics. So it seems that perhaps this could have been for reasons other than just a synergy that they expect to eventually realize. Now, when it comes to last mile delivery, there are a lot of questions about whether or not this is going to be economically viable or socially viable. So think about people in apartment buildings, and if you've used food delivery services, you'd probably pay a little extra to have somebody walk the damn food through the elevator all the way up to your floor, knock on your door, and hand it to you. These robots aren't capable of doing that. Where do these robots stay when they're not actively delivering? What about all the lawless monkeys running around in these jurisdictions that might vandalize the robots or create havoc? Will restaurants easily accommodate this new process? So when you look at the delivery functionality for Uber, you see there's 3 types of delivery options: leave at door, meet at door, or meet outside. So meet outside is clearly going to be the robotics element. And they say customers who order through Uber Eats in a region served by the robots can select robot as the delivery option. Well, aside from the initial excitement of seeing a robot deliver some food, are they really going to choose that option over a human, even if there's a little added cost involved? How many people are going to do this? And when you look at the regulatory concerns, this piece by Supply Chain Dive, why delivery robots face a regulatory nightmare. States can't seem to decide how to handle these sidewalk delivery robots, and it's often the application, the human side, the policy side. That's where things get complicated and messy, right? So the technology may be there, and it has been for a while, but it may not be suitable to solve the social problems that are involved. And we've been looking at delivery robots for a long time. I wrote this piece actually back in 2018. I was down on the Berkeley campus watching the Starship robots deliver food and talking to students. They didn't seem to be overly thrilled about this offering. And when it comes to these various companies today, which one is the leader? Well, it's probably Starship. So they say here they're 99% autonomous, millions more deliveries than any competitor, and they list some of their clients here. You also have Coco Robotics. They've completed over 300,000 deliveries since 2020, and then you have Serve that describes their delivery activities in the tens of thousands. Oh, Starship here with some rather impressive numbers, global service areas. They're focused on campuses, industrial sites. That's quite interesting. Miles driven, 8 million. Deliveries completed, 7 million. Daily road crossings, a challenge for these robots, 150,000. So this article by CNBC, which talked about Starship, said some attempts to make deliveries using fleets of robotics have been hit with setbacks as widespread take-up of the technology has been limited. Absolutely. So when you look at 2 very large players in the industry, Amazon and FedEx, I like these 2 articles juxtaposed next to each other. In 2020, you see here Wired telling us Amazon and FedEx push to put delivery robots on your sidewalk, and 3 years later, FedEx and Amazon still haven't figured out sidewalk delivery robots. From Supply Chain Dive, they say, will mass adoption ever come? That's a great question. So just some key questions here. Is the whole idea of last mile robotic solutions economically viable? I'm not convinced, and I'm happy to wait and see whether or not that's the case. What form factor is best suited for this work? Is it a wheeled operation, or is it in fact a humanoid that walks around as a human would? What are the margins here for each stakeholder in the last mile delivery value chain? You're already talking about an operation that's extremely tight when it comes to margins. So there's not going to be a lot of 70 or 80% gross margins to be realized here. What's the cost benefit for an autonomous car versus a small autonomous robot once we do have autonomous vehicles? Having someone hand you your food seems really appealing. And there's really far too many unknowns at this point to see if this is feasible or even economically viable. And we can leave it to Uber to probably identify the most economically viable option here. And as the gorilla in the room, they'll have the capital and capabilities and reputation to be able to commandeer that. Maybe invest in Uber instead if you're interested in enjoying the benefits of last mile delivery, however it ends up manifesting itself. And if you're interested in investing in Uber, we did this piece on Uber. It's quite edifying. Thanks so much for taking the time to watch this today.